Hi everyone, welcome to the channel Real Week Invest. From today, we are starting a very new series which is NSEW, which is new stock every week. So, today we are diving into deep analysis of our first company which I have chosen after reading all the fundamentals and the earnings of quarter 4 of financial 2025. So yeah, I will be discussing the fundamental analysis, financials, the latest financials, management, commentary, key ratios, and valuation outlooks. So let's get started. All right, so Firstcry was founded in 2010, operates under Brainbees Solutions Ltd, which is the parent company behind the brand. And the Brainbees is headquartered in Pune and focuses on tech enabled retail for babies, kids, and maternity products. The company follows an omni channel model with over 1,000 offline franchise and company owned stores across 900 plus cities in India, along with a robust online presence through its app as well as its website. It also owns popular in-house brands like Baby Hug, Cute Walk, Pine Kids, and Baby OA. Firstcry has expanded internationally, as you all know, especially in the Middle East, UAE, and Saudi Arabia, serving a wide audience of young families. The brand primarily targets children from birth up to 12 years of age, from 0 to 12 years of age. All right, so talking about the key metrics of the company, the market cap is 20,000 crore, which makes it an absolute of mid cap company. And the current market price of the company is 396 rupees. And the ROE stand -4%, whereas the ROCE is 0.4 minus percent. Well, the company has not delivered any dividend till now, and the P ratio cannot be applicable because the company is in loss making. So, talking about the fundamental analysis overview, well, the company has jumped revenue 18% year on year to 7,660 crore, and the cash profit nearly doubled to 209 crore. Adjusted EBITDA margin rose to 5.1%, and their core India multi-channel business turned PAT and free cash flow positive, which is a really very good thing if ye take any company considering its turnaround from here. Talking about the gross margins are also improved to 37.4%. This suggests the company is scaling efficiently despite still being net loss making. Talking about the quarterly performance snapshot. On the quarterly side, we see improving trends. Revenue grew from 1,407 crore in June 2023 to 1,930 crore in March 25. Expenses have flattened, signaling operating leverage, but the operating profit peaked at 230 crore. However, EPS remains negative, as we know, at 1.47 rupees, which is tells us the net profitability is still some quarters away. Now, talking about the annual P&L trends, on the full year scale, sales grew from 508 crore in financial year 19 to 7,660 crore in financial year 25. But net loss is still 232 crore through down from 486 crore last year. The good news is margins have expanded and the loss curve is tampering. So this is a no longer cash burning startup, we can say, and it's maturing into a potential profit engine. Well, talking about the cash flow and financial health. Now, this is a big, okay, let me tell you. Financial year 25 operating cash flow is 159 crore, and that's positive, which is a very good sign. Net cash flow is stable. Borrowing stand at 1,550 crore, and the total assets are now somewhere around 8,858 crore. This means the company is deploying capital into assets and while keeping cash burn under control, which is a key milestone. Well, talking about the CAGR overview, uh, sales CAGR has grown up from 57% over the 5 years. Profit CAGR is grown over 41% in the trailing 12 months, and ROE remains negative at minus 5% over 5 years. But that's expected in a turnaround, and the momentum is building. What matters is now consistency of a company. Well, talking about the management commentary, which I've took from Concall, of course. Well, the key highlights are uh, CEO of the company, who is Super Maheshwari, confirmed the India multi-channel business turned PAT in positive. Well, cash profit jumped 96% year on year, which is a very good sign. And they are focusing on gross margin expansion through home brands. Global bees and preschool segments are growing very fast, where every parent want that their child should also wear something branded, right? And this gives us confidence that growth is not only top line but operational as well. While talking about the ratio interpretation, ROE again, which is we can say minus 4.07%. Yeah, it is negative, but still improving. Operating margin now 3%. PE not applicable due to net losses. Well, price to book ratio PB is 4.3x, suggest rich valuation. These ratio so business still in the scaling phase with improving operating health, but no bottom line profits yet. But still, we can expect the company is in turnaround phase, so it can give some profit. I would like to add this segment that I will be giving my insight on the share. Is it worth the price? I mean, let's answer the big question. It is. Uh, is it 396 share right? So the pros. First, talking about the pros, of course. Strong revenue growth. Cash flow is positive. Home brands plus omni-channel strategy is defensible, but there are some risks. Still loss making. We are just assuming it that the company will start making profit. I mean, maybe from next financial year, maybe. And yeah, this is a classic long-term story. If you believe in India consumption theme, this could be a good pick, but expect volatility. Okay. Yeah, so thank you. If you found this valuable, smash that like button and subscribe for more fundamental breakdowns like this. You can comment also on what or in which company you want the fundamental analysis. We will be doing it, but every week on Thursday we will be coming up with a new company analysis, which in which we can expect a turnaround. So yeah, thank you.